Well, happy Friday to everyone. This is Friday, July 8th, 2022. This is Friday Live with HPK Provident Advisors. I'm your host this week, Brian Peluso. And of course, I'm joined by Mike Kutch, who is a chartered financial analyst and portfolio manager here at HPK Provident Advisors. Going to give us some thoughts on the market. I will add a few brief comments and then I'm going to turn it over to Mike. Fun fact, July 8th, 1776. The Liberty Bell was ringing out in Philadelphia, Pennsylvania for the very first reading of the Declaration of Independence. So that's a little bit of this day in history. We've been getting a lot of questions about the market. Should we be adding money? Should we be taking money out? And so here's kind of the way we look at it. If you are, hypothetically, if you had a $100,000 portfolio and you're taking out $1,000 a month, and let's say your investment in this portfolio, the price per share is $10. Well, if you're taking out $1,000 a month at $10, then you're taking out 100 shares each time you take money out. Most people take money out monthly, but just hypothetically. So you're taking out 100 shares per month. Well, if the price of that investment goes down, and there's the price of some investments have been going down, Mike, we've seen a little bit of that, and he's going to address some of those things. But if the price of that investment goes down to $8 and you still want $1,000 a month, now you got to take out 125 shares. So you're taking more shares out of that portfolio because the price is going down, and then you're going to have less shares to recover. On the flip side of that, a lot of people have said to us, well, gee, should I continue to invest in my retirement plan? It seems like some investments are going down right now. Our answer is absolutely. Because if you flip that around and say you're investing $1,000 a month, well, if you're investing $1,000 a month into an investment that is $10 per share, you get 100 shares. But if the price is now $8, you get 125 shares. So you're buying at a discount, if you will, and buying more shares because the price is a little bit lower. And we really like that idea. If you are taking money out of a portfolio on a regular basis, it becomes pretty challenging, potentially challenging, for that recovery because you're taking more shares out. Now, for those of you who have been delaying your Social Security because you want it to be higher in general, and we can get into the details of this at some other time, but if you've been delaying your Social Security, because oftentimes if you wait, you get a higher check in time. If you've been delaying that and pulling money out of your portfolio, it might be time to kind of take a look at those numbers again. Maybe it's a good idea to turn the Social Security on now. That's something we can run some numbers. There are other ways that we can help folks get a regular income that is not market dependent. So if you're one of those folks who are pulling money out of a portfolio, you're taking more shares out, therefore you have less shares when the recovery comes, which it eventually will, and you want to look at different ideas, give us a call about that. So that's just a quick planning thought for you. So again, we need to emphasize that nothing we're talking about, these are not specific recommendations. These are just ideas, observations about what's going on in the marketplace right now, just food for thought. For specific recommendations, work with your financial professional, give us a call. We'll look at your scenario in particular and all of the details, and then we can kind of refine that. So really nothing we're talking about is saying, hey, go do this right now. These are our observations on the market. So Mike, I'm going to turn it over to you right now. There's been a lot going on. So what are you seeing this week?
Yeah. So just like I talked about last week with the Tuesday reversal lower, the same concept can be applied to moves higher like that, which we saw on Friday and frankly, most of this week. So the S&P 500 and other broad indexes have had a pretty nice week, stringing together multiple days of green, which is something we haven't really seen in a while. In fact, yesterday marked the fourth up day, and that was the last time that happened was the end of March. So it just shows how difficult this environment has been this year. There hasn't been a lot to go on. But I've been paying particular attention to what treasuries have done and the overall bond market yields. And this was more true up until about the middle of the week. That trend that we've been seeing in recent weeks of the yields moving lower has really caught my attention. And that, along with some of these other things, is probably the reason that we saw a bit of a bounce this week. the 2 and the 10-year treasury yields inverted. So that shorter end of the yield curve is actually higher than 10-year bonds. So that along with treasury yields kind of plays into overall just that maybe the probability of recession is rising. It's also seen in the credit spreads. So basically that is corporate bond yields, how much above the treasury yields. And that can be especially seen in the high yield market where that spread has gotten to a level around 6%. It's come down a little in the past couple of days since we got a few decent economic data points are less bad than expected. Another thing I've been watching, the move in commodities, and this is also up until the middle of the week. Commodities were continuing lower pretty much across the board. Crude oil, natural gas, agriculture products. But since Wednesday, all those seem to get a pretty nice bounce. So crude oil is back above 100. I think it's at around 105. So those trends are probably still intact. So the reason why that aspect could have been viewed positive by the market is that's going to lead into the inflation numbers coming down. If commodities decline and continue to decline, that would help reduce the input costs corporations have to pay and consumers have to pay. So overall, all these aren't really good signs, but the market was taking it as good because of the implications that means for the Fed. So I'll talk a little bit about some of that positive news we got later, but something I really want to point out is the value of the dollar, which is about the highest level that we've seen in about 20 years. Now, that kind of plays into the whole recession fear, except that it's basically saying that international recession is more likely, and if that happens, it's going to be deeper than we're going to experience in the U.S. But what that means for stocks and earnings is that companies with international revenue, there's going to be less revenue over there, more exposure on those earnings. So I talked previously about my concerns with the upcoming earnings that analyst estimates are too high. This is just going to play into that more. On the economic front, some of that positive news I was talking about, the ISM services came out on Wednesday, and although it's declining, it came in above expectations, and it's more of a mid-cycle reading than something indicating a recession.
We got the ISM being the Institute of Supply Management, obviously.
Yeah, that's more the services area, non-manufacturing.
All right.
We also got the JOLTS numbers, which is basically the job openings in the U.S. That did decline 400,000, but it's still at 11.25 million. So ballpark, there's about 1.85 jobs per unemployed worker. So still very tight labor market. The quit rates remain near record highs and layoffs are near record lows. So like I said, very tight. We got the release of the Fed minutes, which is kind of just a more detailed description of what Jerome Powell talked about a few weeks ago. Overall, nothing surprising that he didn't already tell us. They did omit something from their previous month statements about reaching their inflation target while still having a robust labor market. So that's a little concerning, but not really surprising to me. It just seemed unrealistic that they could get inflation down that much in that short of time without having some material impact on the labor market.
Right.
So speaking of the labor market, today is jobs day. So we got June's employment report, which overall was pretty decent. They added 372,000 non-farm payroll jobs. But the big surprise was that's 100,000 above what they were expecting. Mm-hmm. So a big surprise there. Wages were pretty much in line with expectations, maybe a little below last month's reading, but overall still pretty healthy. That's really going to have to come down a little bit. The wage gains were mainly in healthcare and some more service-related sectors, like restaurants, for example. So that's really going to hit the lower income worker or be a benefit to the lower income worker, which I'm sure they can really use with how high energy prices and food prices have been.
Good point.
The participation rate surprised the downside. We were expecting it to tick up. It actually ticked down 0.1%. So that's not the trend we want to see. But overall, a pretty good report. We're just kind of in an environment where bad news is good news and good news is bad news. So the initial reaction from the market was pretty negative, with broad declines across most sectors. Then it got into decent positive territory. Now it looks like we're giving some of that back. So overall, I talked about we had a pretty decent gain this week. It pretty much brought us to where we started last week, and we've hit some resistance there. I don't think we're just going to go up from here. There's things that need to happen where I think we'll probably trend lower in the next month or so. Some of those things, we have to see inflation come down. We have to get through earnings season and get a better picture of if those earnings are actually going to come down from analysts' estimates. So we get a better picture of where valuations are at. So I'd like to say it's all up from here, but I'm still staying cautious, and I think it's important to stay patient overall.
Well, we were talking about that a little bit earlier. I mean, you really can, make lemonade out of some of these lemons. If you're a buyer of investments, long-term investments, this is actually a great time to keep adding. And share prices, depending on what you're looking at, might be lower. You might be able to get more shares that hopefully over time will grow. So it could be a decent time. Now, Mike, you had mentioned the bond and the commodity markets. Obviously, there's a lot of things that can, a lot of people look at both the bonds and the commodities and say, well, this is kind of indicative of what's going on, and there might be a higher chance of a recession. And we get a lot of questions about both the bonds, fixed income market, and certainly the commodities, gas, of course. Price of gas is all the talk in the country. So whether they're heading one way or another, how do you know if we're in a recession? I mean, some of those indicators say, yes, it might be a recession. How do we know that? When do we know that?
Yeah, that's a really good question, because there are some different definitions on recessions. And to be clear, I don't believe we're currently in a recession like some people talk about. But the chances of us entering one has certainly risen in recent weeks. So many people talk about a technical recession, which is 2 consecutive quarters of negative GDP growth. So if the Atlanta Fed's prediction is right for Q2, that would put us in a technical recession. However, I don't see growth being in negative territory for Q2. It's not because I think I'm smarter than the Atlanta Fed members. It's just the way they calculate it. They just extrapolate the data out. So I think we'll come in positive. But regardless, that's not really what a true recession is, the way most economists in the Fed view it. The actual announcement of a recession is declared by the Business Cycle Dating Committee, which is part of the National Bureau of Economic Research. A recession usually isn't declared until we're coming out of it. So it's not that helpful as a tool for an investor. But overall, they look for a broad, significant decline in economic activity that lasts more than a couple of months. They look for declines in employment, which we haven't seen, income, personal consumption, retail sales, industrial production, and overall GDP growth or lack thereof. So some of those metrics are experiencing slowdowns, but in my opinion, to have a true deterioration of economic growth, we need to see that damage happen to the labor market, which remains very tight, and that was confirmed this week.
So even the professionals, the number crunchers, they don't really know. I mean, they're not going to declare it until after the fact, essentially.
Right. It's more just a gauge when we're looking back on it to say, oh, that's when the recession started, and this is when it ended. So not that helpful as an investor. It's more important to watch the economic data come in and see it slowing.
Right. So what are you looking at for the week ahead?
Yeah, well, no light week. We're going to have the inflation numbers coming out, which, like I mentioned last week, is probably the most important economic data point right now. So we'll get consumer price index on Wednesday, the PPI on Thursday, followed by retail sales on Friday. So a lot going on. It's also the start of earnings season with the major banks reporting.
Oh, yeah.
So all these are potential market-moving events, more the economic data than the banks. Earnings season will be very important, but banks. I mean, it's something to watch, but the bulk of earnings are going to be in the coming weeks.
Right.
So on an inflation front, yeah. So on the inflation front, many economists are expecting the headline number to reach a new high, but to see that core number trend lower. I was a little more confident that we'd be seeing peak inflation numbers if those commodities continue to roll over. But like I said, they're having a bounce, so that's probably not going to seep in yet. So that's what I got on the markets and the economy this week. Do you have anything else for us, Brian?
I don't. It's these are interesting times, and Mike, we certainly appreciate your insights and your thoughts. And you alluded to it earlier. I mean, it's really hard to pick a direction right now. There's a lot of things that we've got to see yet, but the principles of financial planning remain the same. Invest as much as you can, as often as you can. Give yourself plenty of times for your goals, whatever those goals might be. Seek out qualified advice and guidance on your financials, and these things happen. We've had recessions before. We've had a lot of turmoil around the world before, but those core principles really don't change much. So that's that. I would just conclude on that. And Mike, thanks again for all of the research and the insights. And next Friday should be interesting because there's a lot of information coming out. What's that, Mike?
Never a dull week.
No, that's why we love doing what we do.
Oh, absolutely.
It's never the same, and it's always exciting. So we will be back next Friday, every Friday at 12:30 p.m. Eastern Standard Time for some thoughts on planning ideas and thoughts on what we see happening in the markets. Certainly, if you have any questions about your situation, just give us a call. Our office number is 724-463-1331, 724-463-1331. You can get a hold of me or Mike or any of the other planners here. So you guys have a great weekend and be safe. And thanks again, Mike. Talk to you soon.
Bye.